All right, it's Eric von Blucher with Lean Associates Multifamily Group in the Carlsbad office here in San Diego County. We're going to go over the monthly multifamily report for the month of October 2025. And in this report, we're going to go over a few details um, going from sales activity and for sale activity. And you can see here we have a slight decrease of cap rate from 5.2 to 4.8. And this is including 5 units and larger throughout the county of San Diego. And you can see in the month of October, we actually have had a steady decline, 330 to 317 to 267 a door. And volume has declined from September, October as well to 113 million. And we're getting a little closer to a sale versus ask price, getting closer to that equilibrium of 4%, 5% difference between sale versus ask. Right now, we're still in the 4 month to sale range. So basically, if you're in the 60 day on market time, you should have a pretty good idea of where where the market is bearing for your property. Here we have a decline of sales volume, as you can see here from Q4 of 2023, Q4 of 2024, all the way down for Q1 25, Q2, Q3. And we all are also seeing a price per unit, and this red line start to sink as well at the same time. I also have another chart for you to look at, which also shows a different subset. So if you look at just 5 to 100 units, we actually see an increase of volume just in the sub-institutional realm. So an increase of volume for this year for Q1, Q2, and Q3. So I thought I'd bring that up. The inventory had the highest points basically in June, July, and August, and has started to get absorbed over the last couple months, whether deals are going off the market, not selling, or actually being purchased, or a little bit of both. For sale summary here for San Diego County, uh, the volume of deals on the market has picked back up a little bit. We're still in the 1.1 billion range for amount of real estate on the market for apartment buildings in San Diego County. And you can see here the asking price per unit it's lower than it was in towards the start of the year, February, March, April. But right here, 390s on average. Now we're at 370, 360, 370, and cap rate's basically been around the same, 4.5, 4.6. We're seeing a couple 4.7s pop up here, which could mean that we are trending in a direction of closer to 5 caps, but we'll see. Sale price per unit here is trending upwards in the blue line, and the amount of inventory for sale. So you basically see this bump here of inventory, which I think maybe we see a little bit of delay in a price per unit to coming back up. But there could be I don't know, there could be a variety of factors here, but we'll see what happens with some perspective over the next few months. For sale volume and cap rate is increasing. I mean, we also had a pretty high cap rate month here in August. So we'll have to see again, how the basis points, the 25 basis point drop now and another 25 soon. We'll see if that's making a difference as far as our cap rates go. Vacancy is starting to head down in a better direction, as you can see here. We're still in the mid fours, and you're seeing that other submarkets are in better shape and others are in worse shape, of course. Effective rent is basically plateauing in the let's call it $2,400 range. Cap rate is basically medium flat, like you're in the 4.5 range. Sale price per unit, as we saw before, is trending downwards. And again, we might have some anomalies here with some lower price per unit deals that have sold. Population's increasing, which is a good thing for us and for vacancy. Job growth, basically a little bit flat. I mean, a little bit increase here. Unemployment rate going down, household income going up. And I thought I'd show you two things regarding that. So household income, I'll call it 110 grand a year. The median list price for a home in San Diego County is about 950. If you look here, the 944 median home price, and it costs $5,500 to pay a mortgage for that home. Here you see it was 5608 a year earlier, and now it's 55, so it's getting a little bit better, but it's still not that affordable. With a $110,000 salary, that leaves you with about $3,000 of income to pay everything else, car insurance, food, etc. So it's still cheaper to rent than it is to own. We have here a closer equilibrium between the 10-year treasury rate and the cap rate. We have about a 1 point delta between the two. If you could see here, when we had high spikes of volumes in sales for multifamily, you could see the delta of close to 4% from the 10-year to the cap rate. That means that a lot of investors would rather be putting their money into an apartment building versus a 10-year treasury, where right now it's about the same. So the desire to take on full management, full hands-on management versus just putting your money in a 10-year treasury, there's not that much of a difference here. And you can see how we break it down between SOFR, the 10-year cap rate, and the advantage between the cap rate and the 10-year. And I think the interesting items here are to look at when you're seeing the higher advantage percentage. Let's just call it 410% and 582%. So these deals are going in escrow here, but closing here with the sales volume. So you're seeing pretty large volumes when you have the advantage over, call it, even 25, 50%. So here's a 208% advantage when the 10-year is at 1.32, cap rates are at 4. So you can see a $2.4 billion volume here for Q3 of 2021. And what I wanted to show you is basically here in Q3 of 2025, we're actually starting to see a healthier advantage again, 4.26 to 4.98%. And I think for those trying to continue to look for that to have a positive leverage, it's still a really tough thing to do here in San Diego. If you can see the overnight rates at 4.33, or the SOFR rates at 4.33, and our cap rates at 4.98, it's really hard to try to get that delta here for investors. But this 8 to 17% increase in advantage hopefully is going to signify a larger volume of deals in Q4 of 2025, but we'll have to see. You can download this report at stmultifamily.com. You can contact me 760-929-7846 or email evb@lee-associates.com. And any suggestions or comments or data that you'd like to see, please let us know. We'd be happy to add those. Thanks so much.